Welcome back. In this session, I'd like to talk about applying probabilistic tools to questions that we face in investing in finance. Let's start simple. One of the fundamental propositions in investing is that the market follows what's called a random walk. That still remains one of my favorite books, A Random Walk Down Wall Street. But what does that mean when you say the market follows a random walk? Basically, you're saying that there's a 50% chance markets will go up and a 50% chance markets will go down on any given day. Thus, if you have a random walk market and you track the market for 100 trading days, you should expect to see roughly 50 up days and roughly 50 down days. So often, to test whether markets are a random walk, here's what researchers do. They collect what markets do for 100 days, 1,000 days, 500 days. They look at the price changes up or down each day. And they look to see how close to 50-50 you get. So you've got 500 trading days, you'd expect to get 250 up days and 250 down days. But what if you get 260 up days and 240 down days? Can you reject the random walk hypothesis? Not so quickly. Here's why. Even though the chance that the market will go up is 50% in a random walk, if you take a bunch of draws, in this case 500 trading days, the actual probability of up days can vary from the 50% purely because of chance. In fact, the standard error, remember that we talked about standard error in the context of regressions, the same thing applies in the context of probabilities, can be estimated as follows. If you have a true random walk, 50% up days, 50% down days, you take the product of the two. So in this case, 50% is the up probability, 50% is the down probability. And you divide it by the number of days in your sample. In this case, it's 500 days, and you take the square root. If you have 100 days, take the square root of 0.5 times 0.5 divided by 100. In fact, let's take the 100 since it's easier to take the square root of. 0.5 times 0.5 is 0.25. You divide by the square root of 100, which is 10. You come up with 2.5. What does that mean? Well, when you look at 100 trading days, even if the market follows a random walk, you should expect to see as many as 55 or even 56 trading up days purely by chance, or 55, 56 down days purely by chance. More generally, even if you don't have a random walk, like there's a 60% of chance something happening and a 40% of it not happening, you can compute the standard error as the product of 0.6 times 0.4 divided by the number of trading days, the number of observations in your sample. So if you ask me with 95% probability over 100 trading days what I'd expect to see as the range on up days purely by chance, remember 95% probability is two standard errors. The standard error here is 2.5%. I'd expect to see as high a number as 55 or as low a number as 45. So you got that? Here's what we're going to do. We're actually going to look at what happened to the S&P 500 in the 1,257 trading days between January 1st, 2016 and December 31st, 2020. Over that period, the market was up 700 trading days and was down 557 trading days. In terms of probability, 55.69% of the trading days were up days and 44.31% of the trading days were down days. Now, could that be by chance? Well, let's check it out. Let's take the random walk null, 50% up, 50% down, divide by 1,257, much bigger sample. The standard error in my probability is about 1.41%. What does that mean? Well, if I use a 95% confidence interval, two standard errors, that means given that I got a 0.5569, 55.69 actual percentage of up days, you can say with 95% probability, the range I can get on my up days is somewhere between 52.87% and 58.51%. Notice what that range is preempting. It's saying 50% is outside this range. Based at least over this period, you can reject the hypothesis that there were as many up days as down days. Now, before you go any further and do something crazy based on this, if you ask me, can I extrapolate what I found in this period to the future, I'd suggest that you be cautious. And here's why. These were 1,257 trading days between 2016 and 2020. What I forgot to mention was this was also a period when the market was strongly up. In periods that the market is strongly up, you might expect to see more up days than down days. Before I tell you what to do for the future, I'd need to look at a down market to see if in fact there's some averaging out that happens over time. So that's a simple probability that I've estimated by looking at historical data. Let's talk conditional probabilities. In addition to trying to figure out what the chances the market will go up or down on any given day, here's another question you can ask. Given that the market was up yesterday, let's say you know what the market did yesterday, it was up yesterday, does that tell me about what the market will do tomorrow? It's a conditional probability. Condition on what I saw yesterday, can I predict tomorrow? Let's see how we can use the data that we have on the S&P 500 to answer this question. Remember those 700 up days I had? I looked at the following day in the market. And here's what I saw. In the day following an update, there were 367 up days and 333 down days. In other words, 52.43% of the days following an update were up days and 47.57% were down days. Incidentally, that 52.43% is not different enough from 50% for me to reject the hypothesis that knowing that the market was up yesterday doesn't help me very much about forecasting the next day. So buying stocks after a strong update wouldn't have worked for you that well. When I looked at the 557 down days, here's what I saw. In the day after a down day, there were 332 up days and 225 down days. 59.6% of the days after down days were reversals. You saw an up day, and 40.39% were down days. You know what? That number is significantly different from 50%. You'd use the same technique I used to compute standard errors in the previous page, and you're going to see 59.6% is well beyond the realm of randomness. So what does that tell me? If the market is down, there's a greater chance, statistically, the market will be up tomorrow than down. But if the market is up, it tells me very little about tomorrow being an up or a down day. Again, this is specific to 2016 to 2020, but I'm using the data to form probability judgments. Let's do one final assessment of probability. Now, when you take a series of trading days in the market, in this case 1,257, one of the questions you often ask is, hey, what is the chance I could get 3 up days in a row or 7 down days in a row? Let's try to answer that question using what we've already estimated from the data. Remember, looking at the data, there was a 55.69% chance of an up day and a 44.31% chance of a down day. Let's take that as our best estimates of probability of up and down days. If you ask me, what is the chance I will get 3 up days in a row, a cumulative probability, I need to have an up day first day, that's 0.5569, followed by another up day, 0.5569, times another up day, 0.5569. You know what the cumulative probability of 3 up days in a row is? It's only 17.27%. How about 5 up days in a row? You take 0.5569, basically raise the power of 5, you get 0.0536. You can get 5 up days in a row, and there's a 5.36% chance of that happening. Incidentally, even in a random market then, if you put 0.50 instead of 0.5569 as your estimate, notice that there is a probability that you could get 6 up days, 8 up days in a row. So when you see people say, well, I had 6 up days in the market in a row, that must mean markets are not random, they've forgotten their probabilities. If you ask me to estimate the probability that you'll have 3 down days in a row, going back to the 44.31% I estimate is the probability of a down day, there's an 8.7% chance of 3 down days in a row, at least in this time period, 0.4431 raised to the power 3. There's only a 1.71% chance that I'll see 5 down days in a row with a 0.4431 probability of a down day. So let's move on to a second application in investing. Investing in finance, we often look at portfolio managers and companies, and we measure them based on metrics, we rank them. And we do it both to assess how they've done in the past, but also often as predictors for the future. I know, every mutual fund tells you that past performance is not a predictor of the future, but that doesn't stop them from blasting out their past performance, especially if they're good performers. So funds often market themselves on the basis of past performance with this warning in place. And investors often pick funds based on past performance. Now, is that a sensible strategy? Should you be chasing past performance? One way of testing that strategy is to see whether there's persistence, whether funds that did well last period continue to do well in the next period. So here's something that you might find useful to make that assessment. There's a probability called a transition probability. Now you're saying, what is that? Let's take a very simple example. Now, S&P every year classifies money managers into, or in this case, all domestic mutual funds into 4 quartiles from best to worst. The first quartile are your best funds, your fourth quartile are your worst funds. So what this is a probability matrix that looks at the returns on funds of one 5-year period followed by a second 5-year period. So let's assume I look at returns from 2005 through 2010, then 2010 through 2015. And here's what it tries to estimate. If I know how funds did in the first period, is there any predictive power in how they will do in the subsequent time period? So let's take the 485 funds that were in the first quartile in the first 5-year time period. They were the best funds. If you look at what they did in the second time period, 31.75% of those funds continued to be top performers. They're saying, what did I compare it to? In a world where every fund survived, you know what you should see here, right? If this process is completely random, you should see 25% in every one of those, because if it's completely random where you end up in your rankings, you could be in the first quartile this period, it tells me nothing about the next period. In this table, S&P is being complete. They tell you 31.75% of the funds that were in the best performing funds in the first period continue to be best performers in the second. That's higher than the 25% you'd expect. Now, the remaining 3 quartiles, you get 20, 18, 20, so they're pretty close to each other. 8% of the funds were liquidated. That's actually a good thing to keep track of, because there's survivor bias that we talked about. Not all funds survive. So among the most successful funds, 8% were liquidated in the following 5-year period, and 32% remained in the first quartile. Let's go to the funds that ranked the worst in the first time period, the fourth quartile. And let's look at what happens to them in the next 5-year period. Well, 11% of these funds are able to transition and become the best funds. They end up in the first quartile. 24% stay in the worst quartile. But here's a number that jumps out. 31% of the worst performing funds end up being liquidated or merged. So let's start with what we've learned from this table. If I look at performance and I look forward, worst performing funds are more likely to be liquidated or terminated than best performing funds. And among the surviving funds, the best performing funds are more likely to stay best performing, and the worst performing funds are more likely to stay. There is persistence here. Now, before you extrapolate and generalize these results, S&P provides similar transition matrices for different markets, different geographies, and you can see it varies across geographies, varies for bond funds versus stock funds, for value funds versus growth funds, small funds versus large cap funds. It changes over time period. There's an incredible amount of volatility in these numbers. You're saying, so what? If your end game here is, should I act on what I've seen in this fund? Should I just put my money in the best performing funds? They are more likely to survive and stay best performing. People who've tried that historically have had a really difficult time making money off what this table is telling you, because it goes back to that point about converting statistical significance to economic significance. So again, let's rehash. If I rank all companies into 5 groups based on performance, and I look at this performance in the next period in 5 groups, and I look at how many funds make that transition, I have a sense of what I should expect to see. If it's a pure random breakdown, you just move from ranking to another, the funds in the top 20% should end up in any one of the 5. So there should be 20% in each of the 5 classes, assuming full survival. Of course, numbers can be different from 20% because of the standard error, but if there you see 35 or 40 or 45%, clearly that violates the notion that this is all random. Another application, again, of probabilities. Let's move to a third place where you're likely to run into probabilities. If you lend to a company as a bank, or you buy their bonds, which is equivalent to lending to the company, one of the things you worry about is, will they default? In this table, I've given you the percentage of corporate bonds globally that have defaulted each year from 1981 to 2020. You notice it rises and falls. What drives that? Recessions and recoveries. During recessions, during crises, you see more defaults. So if you ask me what is the probability of default in 2020, and I could give you only one number, I'm going to say it's roughly 3 to 3.5%. That is the number that I get for 2020 as the percentage of bonds that defaulted. That's the probability of default across all companies and all bonds. But let's face it, not all companies are created equal. Some companies have less credit risk, default risk than others. The default risk or rate should be therefore higher for companies that are riskier, smaller, have more debt than companies that are safer. So what if you ask me for a conditional probability? Well, one simplistic way to give you a conditional probability is to classify companies based on their default risk. And the simplest way to classify these companies is based on bond ratings. So in this case, I've classified companies from AAA, AA, single A, all the way down to high yield bonds. And as you can see, the probability of default varies widely across these companies. Among high yield bonds, the probability of default over 20 years, and that's also a factor that will drive the probability of default over what time period, is small, maybe 2%. But the probability of default over 20 years, if you have a triple C or a high yield bond, is close to 50%. That's a conditional probability of default. If you gave me the bond rating for a company, triple B, double B, and you asked me what is the probability of default, I'll probably ask you over what time period, because that will affect my estimate. But my probability of default will both reflect the rating of the company and over what time period you're interested in estimating that probability. Now, incidentally, this probability of default is of course central to what banks do, what corporate bonds are about. So people have tried to come up with ways of estimating probability of default, often using statistical techniques. A colleague of mine, Ed Altman, in the 1960s, actually came up with a model for predicting bankruptcy. He came up with a score called the Altman Z score. He actually used a statistical technique called multiple discriminant analysis. Sounds fancy, but think of it as kind of an expanded version of a regression where you're using variables, in this case independent variables, to predict the likelihood of default. So he came up with 5 ratios, and you can see the ratios listed. Working capital is a percent of assets, retained earnings. Saying, how did he come up with the 5? Well, he looked at dozens and dozens of ratios, and these ratios seem to do the best job of predicting which companies would go bankrupt. His sample size was small because in the 1960s you collected data by hand. He looked at 66 manufacturing companies, 33 of which went bankrupt between 1946 and 65, and 33 of which survived. So he was trying to forecast which companies went bankrupt, and he found a way of connecting these ratios to that bankruptcy. So he came up with this ratio, and it essentially looks like a regression equation with coefficients. If you plug the numbers in for your company that you're interested in to this equation, you come up with what's called a Z-score. And he actually mapped out what that Z-score tells about bankruptcy in a very visual way. He said if your Z-score is between 3 and 4, your company is pretty safe. It's between 1.8 and 3, it's in the gray zone, and it's not very risky, it's not very safe. But if it's less than 1.8, it's in distress. And you're saying, how did he come up with the 1.8? By looking at the 33 companies that went bankrupt. Notice the similarities to what we talked about earlier with logit models and Probit models. Multiple discriminant analysis is essentially trying to forecast default, but it's not giving you a probability, but it's giving you a score that can be converted into a probability. Now, there are people who've taken what at Altman did with multiple discriminant analysis and used logit models to predict probabilities of default. In other words, they do the same thing that Altman did. They take companies during a period, 500, 800, 900 companies. They look at companies that went bankrupt, companies that did not. They try to find variables that will help them predict bankruptcy. But in a logit model, the difference is the score you get, the output you get, will actually be a probability. It will be between 0 and 1. It's an extension of the same thinking process. Now, there are actually Probit models, which is a way, logit and Probit, of course, are both ways of estimating probability. It's just a difference in how you convert the number you come up with into a probability. And the place where Probit models have found their use in investing in finance is in predicting which companies in the market are likely to be targets of hostile acquisitions. You're saying, why would I be interested? Because if you can invest money in these companies ahead of the time, you're going to make a lot of money. So here's how Probit models are usually built up. You start with all companies that are traded at a particular point in time, maybe 2010. Then you look at how many of those companies were taken over in a hostile acquisition between 2010 and 2020, and how many were not taken over. Then you come up with some hypotheses about what you think drives hostile acquisitions, that it's more likely if you have a stock price that's lagging, your accounting returns are bad, your managers don't own many shares. And then you build this Probit model just like you build a regression. But the end result is you end up with an equation that will give you a probability of a hostile acquisition. I'm going to show you a table that's going to be daunting, but don't be too daunted. It's from a paper that tried to use exactly this approach to estimating the probability of being taken over in a hostile acquisition. If you're, don't get too caught up in why are there 5 columns, let's take the host Wall Street Journal. So these are hostile acquisitions as identified by the Wall Street Journal. So basically, there were, in this case, 1,096 hostile acquisitions between 1975 and 96 out of a total number which is much, much, much larger. Here's what you have is the output from the Probit model. Basically, you have the constant, that's like an intercept in a regression, and you have variables that this researcher has thrown in because they felt that these variables are good predictors of hostile acquisitions. There's return equity. The hypothesis being companies with terrible returns on equity are more likely to be taken over. And return equity bears that burden. The lower your return equity, the more likely you'll be in a hostile acquisition. So higher return equity companies have lower probabilities, you have a negative coefficient. Higher sales growth makes it less likely that you'll be in a hostile acquisition, negative sign. More liquid companies are more likely to be targeted in a hostile acquisition. Companies with a lot. So basically you see this equation play out, and I won't go through every variable, but you can see that the researchers come up with variables that he or she believes will predict hostile acquisitions and built a Probit model. You know what you can do? You can take this model and plug in numbers for your company today. And if you believe this model still holds, you'll get a probability of your company being the target of a hostile acquisition in the future. So Probit models are designed for events, hostile acquisitions, default. And they're built the same way you build a regression. The only differences are your dependent variable takes on a value of 0 or 1. 0 if your company is not taken over, 1 if it is. And that your prediction, what you get out of the regression model will take the form of a number between 0 and 1, a probability. Let's talk about decision trees. Decision trees are most useful when you have risk which is sequential. The example I gave in even the earlier session was of a pharmaceutical company with a drug that is up for approval. So let's say you're a young pharma company. You come up with a drug to treat diabetes. You've entered phase 1 of the FDA approval process. Incidentally, there are 3 phases in the process in case you're not familiar with this. You're thinking about entering phase 1. And here's the information. It'll cost you $50 million to enter phase 1. And there's a 70% chance the drug will complete the first phase. Remember, you're not going in blind. You know something about your drug, what it does well, what it does badly. So you think there's a 70% chance the drug will succeed. If it succeeds, you enter phase 2. You're saying, what happens if it fails? The game's over. If it succeeds in phase 2, the drug will be tested on a bigger sample. It'll cost 100 million to do phase 2. And in phase 2, there's a 30% chance your drug will prove successful, not just in treating, will prove successful in treating type 1 diabetes. There's a 10% chance that you could hit the jackpot, that your drug could be good in treating both type 1 and type 2 diabetes, making your market bigger. And there's a 10% chance that it'll succeed in treating only type 2. So you don't know which will happen, type 1 and type 2, or type 2 diabetes. And there's a 50% chance that you will fail phase 2. So there's a 30% chance you'll fail phase 1, a 50% chance but if you get through both phase 1 and phase 2, you get to phase 3 and you do the big test, 4,000 volunteers. This will last 4 years and it'll cost you 250 million. But once you enter phase 3, there's an 80% chance of success. You're saying, how do companies come up with these probabilities? Because other drugs have gone through the pipeline. You have a sense of success rates, especially if you can look at history. If it's tested on both types, the phase will last 4 years and cost 300 million. If it's tested on only one type, it'll cost only 250 million. And there's a 75% chance if it's tested on both types that it'll be successful. If the drug passes through all phases, then you're ready to develop the drug. And I've given the cost of developing the drug, both for one type of diabetes and both, and what kind of cash flows you can expect to get for the following 15 years. So think of where we are right now. Right now, we've not even decided whether to enter the phase 1 approval process. We have estimates of probabilities of getting through each step in the process, and estimates of what life will look like if we get through all three, depending on how we get through it. I'm going to try to convert this data into a decision tree. So let's start. You're right here. You're at a decision point. You have to decide whether you want to enter phase 1. Why is it a decision? Because if you decide to do it, you'll spend 50 million. You have the choice. Remember right now, say, look, this isn't worth even trying. You can abandon right away, in which case it ends. If you test, there's a 70% chance of success. That's determined by chance. There's a 30% chance of failure. If you fail, the game is over. But remember, you've now spent 50 million, you're not getting back. If you succeed and you spend another 100 million, there are, in this case, 4 possibilities. One is that it works on both types of diabetes. There's a 10% chance. If that happens and you spend another 300 million and you go into the third phase, there's a 75% chance of success. And if that happens and you develop, you'll make 400 million a year every year for the next 15 years after an initial investment. Of course, you can always choose to abandon at that stage, but remember, if you abandon at the last stage, everything you've spent up till then becomes money lost. If in phase 3 it works only on type 2 drugs, then again there's a follow-up of an 80% chance of it succeeding, 20% of failure. If it fails, you stop. If it succeeds, you have a choice. Do you develop or not develop? If you develop, you make 125 million a year for 15 years and you spend 500 million. If it works on only type 1, very similar breakthrough, and if it fails, the game is over. But again, after you've spent the money. This is what your decision tree looks like. It captures all the information you saw on the previous page, essentially as a decision tree. You're saying, how am I going to use this? Well, remember, decision trees can help you as you start rolling them back. So let's start with the last end of the tree, because that's where you know things, and ask, hey, what will I do in the last stage if I've gotten to success? Well, it turns out that if you get to the last stage and you have success coming through phase 3, you're always going to develop. But how much money you're going to make is going to vary depending on whether you develop. If you know, it can range from your best case scenario, both types of drugs, you can make 887 million. Worst case scenario, you're actually not going to break even, but you're still going to develop because it minimizes your losses. So basically, I have a sense of what I should do, then I go back to the previous. So that's what it means by rolling back. I take my decisions and I look at what my expected value is. 75% of 887 million is 75% of 887 million plus 25% of minus 366 million gives me 573.71. That's my expected value. So at each phase, I compute my expected value. I go back to the previous phase and I roll it all the way back. So at each phase, I'm bringing in both the probabilities and the expected cash flows into my numbers. So let me be very specific again. The way you get your expected values is you take your probability times your cash flows or your values. You get the expected value. And if I roll it all the way back to today, my expected value from testing is 50.36 million. Saying, what does that mean? Remember, right now you face the choice as to whether you want to enter phase 1. Given the entire tree with all of the uncertainties in there, the expected value from entering phase 1, even though you have to spend 50 million, the expected value is 50.36 million with all the cash flows incorporated. That is positive, so you should enter phase 1. Spend the 50 million, enter phase 1. There are no guarantees. You could end up regretting everything you've done if the wrong outcomes come about. But life is full of uncertainties. You got to make your best estimate given what you know. Which brings me to a final example before we put this session to rest. Talk about scenario analysis. Scenario analysis is best designed when you face explicit scenarios that cover the spectrum of choices where your outcomes can be very different. So I was valuing easyJet, the UK-based airline, in 2019, and Brexit was still playing out. We had no idea whether Brexit would be done or not done, whether you'd have a soft or no Brexit, a bad deal Brexit, and no, everything was on the table. You're saying, why did that matter? Because for an airline, it was a huge issue as to whether how Brexit was handled would make a big difference for easyJet. So I actually valued easyJet under 3 scenarios. I won't go through the specifics of the valuation because that has to wait till we've dealt with the mechanics. So I looked at 3 scenarios. One is there's a no deal Brexit. Basically, the UK government just walks away saying, we don't care that there's no deal, we're just going to walk away. Your worst case scenario is an airline, because now the EU is going to cut you off and you have to spend a lot more in terms of costs to continue to fly people from the UK into the EU countries. Lower revenue growth, lower margins, lowest value. So if there's a no deal Brexit, the value that I got for easyJet was £12.02 per share. And I think that, at least in 2019, when I looked at this, there was a 25% chance of this happening. The most likely scenario seemed to be that Brexit would happen, but the deal wouldn't be a great deal. Under which scenario, you're likely to get a $300 million upfront cost. Revenue growth is a little higher, margins are a little higher, value of £15.7 under the most likely scenario, 50% chance of that. There was actually a small 25% chance that you'd actually get a soft Brexit, which means the EU and the UK would come to a very good agreement, in which case easyJet would not have to pay the upfront restructuring costs. The restructuring costs for easyJet is they would have had to open operations in an EU country to meet the requirements of the EU if Brexit was not handled right. In this case, if it's handled well, that restructuring cost goes to 0. Your revenue growth is going to be whatever the revenue growth was under bad deal, but your margins are higher because your costs are lower. The value that I get is £19.38 per share. As I said, until you've learned the mechanics of valuation, you're saying, where do those numbers come from? But the bottom line is I have 3 scenarios that cover the spectrum of choices. You add up the probabilities, they add up to 100%. My expected values under each scenario are listed. So if I look at the values across all 3 scenarios, my expected value across the scenarios is £15.70 per share. The stock was actually trading at about £13 per share. I would buy easyJet looking across the scenarios. There are times when scenario analysis can be helpful, especially if you are trying to value a company under a regulatory framework change that could happen, that could significantly alter the company's growth and margins. Take advantage of the tools you have in your arsenal. So I hope you found the session useful, and thank you very much for listening.